What's up, world? So I just finished my trading for the day. Thankfully, I was able to finish green. And so now I typically just shift focus into navigating tax compliance issues with a lot of our clients across the US. So for those of you who don't know me, my name is Brian Rivera. I'm the managing partner of Trader Tax CPA. So we're located in beautiful Orlando, Florida. All of our clients are virtual, so we talk to people all across the US throughout the week. And as you can see, I'm in my home office. So this is where I do my day trading, and this is also where I do all of our tax work. So as I was working on a client tax return today, I was reminded of a teachable moment that I think the rest of the world could benefit from. And that is the importance of checking your 1099-B. So your 1099-B is a document that your broker, all US-based brokers, are required to send out, and that's typically sent out around February 15th of each year. Now, what this document is, it's basically your transcript used to record your gains and losses for the year. So you'll see a couple columns. The first column is going to be your sales proceeds. So that's going to be how much you made from the sales of your transactions. And then you'll see a cost basis, which is essentially how much you paid for those transactions. And then you'll also see what's called a wash sales disallowed column. So that column is used for anyone who's non-mark-to-market. And so if you don't know what a mark-to-market trader is, you can check our website out. I have a couple blogs out there that talk about what mark-to-market is and why you should elect it. And maybe I might put out a future video specific to this topic, right? So you have your sales proceeds, you have your cost basis, and you have your mark-to-market election. Now, you'll see a further breakdown on short-term versus long-term gains, right? So short-term is going to be anything that you've held less than 12 months, and then long-term is going to be anything you held longer than 12 months. Because right there is, you're going to drive different tax calculations. And so depending on what tax bracket you are in, that's going to drive your short-term capital gains, which is going to be ordinary rates. And then your long-term capital gains is going to be 0, 15, or 20%, again, depending on your tax bracket. So what I want to talk about is why it's important to check this document. And so what we typically do is when we prepare a return, we will request the trade history files from all of our clients. And that's just an Excel transaction log of all of the trades that you made throughout the year. And then what we do is we do our own independent calculations, and we check that against your broker issued 1099-B. Well, I just ran into a situation where I won't name any clients, I won't name any particular names due to privacy policies that we have with each of our clients, but I can use high-level examples. So this trader was extremely successful, high mid six figures, $450 to $500,000 range P&L realized side. And so when I got his documents, the first thing that jumped out was his broker issued 1099-B showed that he made $900,000. And well, we would love, to make that. That wasn't the case. And so when we were reconciling his transactions, we noticed that his broker double counted all of his transactions for this particular broker. And so what we did was we issued a CPA letter for our client to send to the broker. There was a little bit of back and forth, but ultimately they ended up reissuing his 1099-B to reflect the calculations that we provided him. So if you're in a situation where, like for example, this particular client, they would have ended up paying double taxes on their realized gains if they strictly relied on what the broker provided them. Now, not to say that all brokers are wrong or all brokers are correct. What I'm saying is you need to do the due diligence in that, making sure that you are validating all the data that your broker is providing you. So just a very good teachable moment. And just remember that when you are filing your taxes, you're required to report all of your transactions on a Form 8949, which flow through Schedule D. Now, if you are a mark-to-market trader, that's going to be Form 4797. So obviously I know taxes are complicated and it's not everyone's favorite thing to do. So as always, I recommend that you either reach out to us for a consultation or make sure that you're working with somebody who is well-versed, specifically day trader tax issues. So if you found this video helpful, feel free to give us a like, feel free to share it, and also subscribe to our channel. We're going to continue to put out videos for the day trading community and to help you guys navigate the complex tax laws. So as always, good luck with your trading and have a great day.